Well, thanks everyone for joining us today on this Zoom event. We're calling it the Investors quote unquote decision-making dilemma. I'm Jeff Malec, Managing Director at RCM. And today's featured guest is Eric Crittenden, co-founder and CIO of Standpoint. One of the smartest guys I know in the alt space. Love to trade philosophical and statistical and model ideas with him. So if anyone hasn't heard it yet, we also did a podcast with Eric a couple weeks or months ago, I can't remember, where we dove deep on some of the items we're going to cover today. So make sure to check that out. We'll send you all a link when we're done. So welcome, Eric.
Thanks, Jeff. How are you?
Good, thanks. And you're at home in Arizona?
Yeah, I'm down here in sunny Phoenix, Arizona, still in the high 90s. Winter has not come yet.
Yeah, what was I hearing? There were 100 days in a row, over 100 or something like that, or 50?
Yeah,
insane.
It was very consistent this year. We didn't have anything over 120, but it was consistently, 110 to 116 for, I think, the longest stretch on record.
Ooh, outliers. And then one of these days, I'm going to convince you to open those blinds and let us see the beautiful Arizona scenery. But
I try to do that, but people complain that the Arizona sun is so bright that they can't see anything. So I shut them now.
I hear you. So we want today's conversation to be very casual and open. We're interested, these have been in person at a lunch at a restaurant, in Scottsdale or something in the past. In the times of COVID here, we're doing it virtual. So let's all pretend we're at the lunch table. If you have a question, unmute, raise your hand, shout it out, and we'll get to it. With that said, please do be aware of that mute and unmute button. We're all on here live, so please be muted when you're not asking questions, and can unmute yourself if you do. So with that, let's get started. So Eric, it's a super tough environment right now in the investing landscape, kind of ignoring the election uncertainty for a second. Just looking at the world at large, we have bonds yielding close to zero or negative. We have stock markets back up at all-time highs, even with unemployment well below what it was, unemployment well above what it was this time last year. We've got a winner-take-all stock market with Apple and Tesla and Netflix, kind of leaving whatever strategy you have in the dust. We've got all sorts of new types of funds, from tail risk to volatility link to risk parity and more. So kind of wanted to do this conversation of how do we decide as investors what to do, and how do we solve the decision-making dilemma of what do you go into? How do you decide between the different asset classes and whatnot? So let's get to it. Let's start with what I said on bonds. I think
Yes, I'll tell you that in my 23 years of being in this industry, I've never seen a more unusual environment. Can't say that I've seen a more difficult environment, and there's a lot of very challenging problems that people have to deal with and some really tough decisions. And the one that's at the forefront of my mind right now, and obviously for advisors, is how to deal with bonds going forward. So at no time during my career or in any of the data that I've looked at, do you see real yields as negative as they are right now, and nominal yields as low as they are, and bonds as pervasive or included in portfolios as you've seen before. So I've been doing a lot of work, my team and I, on trying to set realistic expectations for bonds going in the future. So I've done tons of Monte Carlo simulations and analysis and read the research. And I just don't see very many plausible future scenarios that include positive real returns for bonds. It just doesn't show up in the math. And I think even for people that aren't interested in things like that, Monte Carlo simulations and bond math, instinctively they know that they've got a problem and they're not quite sure what to do about it. And I'm hoping to share some knowledge, maybe some wisdom, to help people both set realistic expectations, but also make some confident decisions going forward. So I'm going to move to the next page. Here, even the big boys have come around and are starting to agree that people really need to lower their expectations for bonds. You've got Vanguard with their relatively small range for expected returns. BlackRock is predicting a 0% return. And this is for the US aggregate bond index. And PIMCO is a little more bullish at 1.2%. You know, those nominal numbers might look okay to some people, but with inflation running at 1.65%, and, you know, look, we all have to charge fees. You know, the typical advisory fee is 1%. And then you factor in taxes on top of it, you can probably see what I mean when I use the phrase negative real returns or negative real yields going forward. So it's a big problem.
Most people are worried just, can I outpace inflation? But there's other, right? Can I outpace the fees that I need to charge? Can I outpace the growth that I need from that component of the portfolio? So there's a little more involved, right, than just, can I outpace inflation?
Yeah, there's a lot of moving parts. There's the diversification benefit of bonds. You know, can they maintain their negative correlation to stocks if rates don't have further to decline? You know, that's a big deal. You know, most investors that have been invested in something like the aggregate bond index for the past, 20, 30 years have enjoyed a 4, 5, 6% annualized return and negative correlation at the same time. So if both of those disappear on us going forward, what do those financial plans look like? It's a very tough environment. We're all facing our own Windows versus DOS decision in real time. And in my conversations recently with people, I get the impression that most people feel there aren't a lot of good options. So I'm hoping to show you at least how I view alternative investments and some of the options that are available.
What do you say to someone who's like, well, I'll just go into some peer-to-peer lending or some other sort of alternative fixed income to kind of grab the yield that I had expected in the past from my quote unquote bond allocation?
Yeah, there's kind of three avenues that people talk about going down. You know, one is rotating over to bonds that have higher yields, like junk bonds and high yield bonds. But they quickly realize that those markets tend to be very correlated with stocks when stocks are going down. And they realize that I'm probably giving up my diversification benefit, but still incurring bond, taxes. So that kind of defeats the purpose of having the bonds in the portfolio. So most people give up on that or do it a little bit, high yield. Other people, for a while.
You don't see high yield have a flight to safety during a crisis.
Right. All you got to do is look at, during COVID and 2008 and other, the Greek credit crisis to see that these high yield bonds typically become very correlated with stocks when they're going down. So they're not giving you the diversification that you need.
Got it.
A couple other options, tactical managers, alpha managers. I hear that a lot from people. My own analysis of that, looking at all the different mutual funds and ETFs and even some of the hedge funds out there, that alpha, it's not as big as people think it is. It's not as consistent or stable as people think it is. And it's just really a small minority of funds that, from my perspective, have been able to outperform, just the beta of the bond market. And some of those funds are closed. So I just don't see that as a catch-all or a good out for most people. And then what you brought up, peer-to-peer lending and some of this other stuff. The question is, are they going to deliver the beta that you've become accustomed to in the past? The 7 to 10 year treasury has been a formidable investment for 30, 40, 45 years now. And I don't know that some of these new products are going to be able to replace that. So I still think people are going to struggle to find something that's a suitable replacement for a portion of their bond portfolio.
So, and that's the question, what do I do? Do I just cut it out of the portfolio altogether or replace it with what?
Well, I wouldn't recommend that anyone eliminate bonds completely from their portfolio. I think that's way too traumatic. And I am sympathetic to the argument that some people are essentially saying, "Oh, I'm not relying on bonds for a large return anymore. They're really just a risk reducer in a way to control the volatility of the portfolio and get it down to a level that, makes clients comfortable." I get that. I think a more practical alternative is to peel some money away from bonds on an as-needed basis and start looking at other potential investments. In order to try to get back some of that diversification benefit and perhaps some of the returns as well. But definitely not the full allocation. I don't see very many people doing that. That's just going to be too traumatic to the investors, the regulators, and their chief compliance officer.
So don't abandon them altogether, but trim them around the edges.
Well, yeah, to the degree that you need. I could see, I've heard some people, talking about going from 40% bonds down to 30, and that's probably the most that most people are going to be comfortable with. But more importantly, if you're going to do it, the question is where to go. So I'd like to talk about that here in the next slide.
Yeah, hit it.
So I've been in the alternative investments industry for over 20 years now, and I'm going to share with you my perspective on some of these different alternatives. And my perspective comes from two different areas. One is the feedback I've gotten from market participants, advisors, investors, and whatnot. The other one is, what does the empirical data actually tell me in my own research? So I've got most of these well-known alternative asset classes over here in the ineffective column. Now, there's two ways that you can end up on the ineffective column. One is you could have really low returns. You could be such a drag on performance that you caused more harm. You basically created more problems than you solved for people. And some of these are very intuitive. Bear market funds have had a negative return.
Yeah, I was going to say the first two are right. Like no return and lots of volatility.
Yes, a drag on performance, lots of questions, lots of homework, lots of education, basically a nightmare for advisors. That's one way you can end up on the ineffective list. The other way is to just simply be too correlated with stocks when they're going down. So you see some of the worst offenders on there: options writing, REITs, high yield bonds. These are things that tend to have a really high beta with stocks when they're going down, which defeats the whole purpose of the diversification in the first place. I'm not sure why they're still considered to be alternative investments. They might look a little different during good times, but time after time, historically, they look just like the stock market when the stock market's really going down.
Yeah, so they're alternative strategies on stock risk premia instead of an alternative asset class, right?
Right. That's what I tell people a lot, is that they're taking the same structural risk as equities, but that only manifests itself in hostile market conditions when the market's really going down. So
yeah, I tell people you're going into the same stadium, but you're going through gate C instead of gate B, right?
Right. And you don't have the diversification when you really need it. So those are the two ways you end up. And this is just a list. This is my opinion. These historically have been ineffective, according to the advisors that I've talked to over the years in my own analysis. Now I've got this.
Sorry, real quick. Can you talk quickly on low vol stocks? What you mean by that one?
Yeah, so that would be buying stocks that either have a low beta relative to the stock market, or they statistically have a lower volatility, and maintaining an index of those stocks. There's several of these indexes out there. And they became popular, I want to say in the mid 2000s. And they look different than the stock market to some degree during the good times. But like a lot of the other asset classes on this list, during COVID, during 2008, they can't fight the tide, and they tend to have a higher beta and increasing correlation when you don't need that.
Got it. Yeah, and some of those indices and products that I've seen even in the last few years of volatility targeted or low vol index kind of are wrapped in that same bucket.
Yeah, and what I see is, I just strip the titles off of everything and I look at the data objectively. And, I've got enormous databases, 36,000 indexes, every mutual fund, every ETF, most of the hedge funds in the world. And what's interesting is when I analyze all this and I write formulas or algorithms to search for diversification, find me the diversifiers, it filters out 96% of all the different assets. There's just precious few things that aren't structurally correlated with the stock market when it's going down. Now, two of those are over here in this lonely impractical column. Excuse me. Why do I call it impractical? Gold and managed futures have been fantastic diversifiers for decades. You'd be hard pressed to find something that is more diversifying or inoculates a portfolio against, historically against drawdowns and volatility than these two assets. But I still have them labeled as impractical, and I'll tell you why. I'm actually a good case study for this because I spent 8 years convincing advisors to use a healthy dose of managed futures. And I can tell you that even when it's producing volatility dampening results. Even when it's contributing to returns, managed futures on a standalone basis causes more problems than it solves. It's just not at the portfolio level. It causes problems with client psychology, client emotions, client homework, client education. There's just a massive workload that comes along with using anything other than stocks and bonds.
And for something that, right, we used to say causes 30% of the headaches for 10% of the allocation.
Yeah, well, I call it the 90-10 rule. You know, the
Yeah, the
Pareto
math
principle is
doesn't-
80-20, but yeah.
Yeah.
So 10% of the assets in your portfolio cause 90% of the grief with clients. And managed futures in gold, for whatever reason, just seem to stomp on clients' nerves. It's a reoccurring theme. And it's always the same thing. You know, during a quarter when the stock market's up and managed futures is down, clients start to complain. If it happens again, then the homework and the workload just grow exponentially, and advisors become exhausted after a while. So it just feels much worse than it is. So I put gold and managed futures in this category. They're effective, but still impractical.
And now I feel like bonds, per our previous slide, would be in this column as well now.
Well, I think the bonds, 10 years from now, if we're all still around and we do another podcast, bonds I expect would be in the ineffective category.
Yeah. Okay.
It won't surprise me at all if bonds lose their ability to diversify, meaning they just don't have any pop during market sell-offs because interest rates can't go much lower. I could be wrong. I mean, there is definitely a scenario where interest rates go negative. That's possible. But then what do you do after that? Do you go to -6 and then 10 and then 12?
Yeah.
So, I mean, bond math is pretty unforgiving. In order for bond prices to go up, the reciprocal has to go down, and there is a floor down there somewhere. So, and also the returns could be very low. In fact, I think they'll be negative in real terms going forward. So I wouldn't put bonds on the impractical list. I put them on the ineffective list going forward.
Okay. And then my happy place is sad because there's no third column of what's good in the world. We only have two bads.
Well, we're going to go there. So the point of this webinar is to show you how to, you might think of it as alchemy. I don't. I think of it as just reframing. But I'll show you what I mean here. So in order to demonstrate how to take that impractical and make it into something useful, solve more problems than you create for advisors, I'm going to walk you through an experiment that I've been doing for the past couple of years. I call it the blind taste test.
All right. Can I be the monkey here?
Sure. Yeah.
All
So
right.
let me just give you a little background. So I've got
Yeah.
5 different potential investments using all total return data, net of all fees, like everything's pure, going back to the year 2000. And my request is, tell me which one you gravitate most towards. Pick your favorite, and then we'll move on from there.
I would probably go yellow, maybe orange.
Okay. And what would be your least favorite? If you had to eliminate one forever, which one would it be?
Red. Looks like a pretty bad risk return ratio, right?
Okay. Well,
6 times the risk.
so you're not crazy. So when I've done this, about 9 times out of 10, people choose orange in first place.
Okay.
Then after that, it's usually a tie between green and yellow, followed by blue, and then red is always in last place. Always in last place. And so what I've done here is try to force people to be objective and just look at the historical data and make a selection. And they do. And then when I show them the results, I'll go to the next page here. They're always so surprised that they eliminated stocks. And let me explain this. So this dotted line, anything to the left of the dotted line is an asset class.
Okay.
Anything to the right is a portfolio. Now this balanced portfolio is a 50-50 blend between stocks, which is the S&P 500, and the Barclay Aggregate Bond Index. It's just a 50-50 stock bond portfolio. That's what this is. AllWeather is a 50-50 portfolio of the S&P 500 and managed futures, the SG Trend Index. And each of these is rebalanced once a year back to 50-50.
Okay. So, yeah. And my bond pick, now that I see bonds, I want to repick, knowing what I know, right? Because no way they're going to look like that over the next 20 years.
Well, that's the thing, right? The current yield on the 10-year, I think, is about 75 basis points. The current yield is about 91% accurate at predicting what your future returns are going to be, your future compounded returns. Looking back in time, we've become accustomed to, 5% a year. But there's almost no plausible scenario that yields 5% going forward.
And even with that great 19, you can, right? What's that? 11, 17. It's like 3% a year, roughly, since 14.
Right. Yeah. So the point here is, I've been talking to advisors for the last couple of years, and I changed something about my own behavior. I used to be in the business of promoting managed futures. I used to be in the education business, trying to get people to understand that if you mix stocks with managed futures, your portfolio can look like this, potentially. But I stopped preaching at advisors. I stopped trying to force diversification down their throats, and I started listening. And I started really listening and looking for common denominators across advisors. And there were several common denominators. Very consistent theme over and over. Advisors tell me they want something that can, for the most part, participate in the upside of the stock market. That's what they say. It doesn't need to keep pace with stocks all the time, but something like 70, maybe 80% upside capture during the good times is essential. And they're talking about an alternative investment here. That's what they want. In addition to that, they want something that can buffer the downside, something that can stabilize the portfolio during bad times. Now, that doesn't mean that you have to be up when the market's down, but you can't bury them the same way the stock market does. So something like 40 or 50% downside capture. And then they want reasonable fees, and they don't want nasty tax surprises. So they don't want huge tax drag. So after a while, I realized that, well, they're describing what I do. That's the same things that I want. But I don't view that as an alternative. That's just the optimal portfolio. That's the optimal portfolio over long periods of time, the 60s, the 70s, the 80s. So they're describing the attributes of what they're describing to me are those of the all-weather portfolio. I love the all-weather portfolio because it doesn't care about what kind of market environment it's going into. It'll adjust. It's relatively stable. It's got things inside of it that can deal with inflation, deflation, bear markets, bull markets, stagflation, crashes. Could it be that this ideal alternative that they're describing to me is the same thing as what I think of when I think of the optimal portfolio, which in my opinion is all weather.
And you're also getting to me, it's not just this behavioral concept, but also like the embedded rebalancing premium in there too, right?
Right. So when you have diversification, the same diversification that drives people crazy when they're looking at it inside their own portfolio and feeling the regret of why didn't we have all the money in the best performing asset, that same diversification is what lowers the volatility. It's what lowers the drawdowns. And it also does what you just talked about. It gives you the opportunity to rebalance into things that are out of favor. And essentially, benefit or monetize that diversification over time. And if you use a rules-based process, it can be calendar-based, it can be based upon tilts. There's all kinds of different rules that you can use to enforce discipline on the rebalancing. And then an objective analysis of the returns that come from rebalancing over time is pretty eye-opening.
To me, the power of the rebalancing aspect is, right, who in their right mind wanted to put money into stocks at the end of 2008, right? It was as scary as can be, or even here in March, right? It's as scary as can be if you have some forced wave of, hey, I have to take profits from B and reinvest it in A. It's a forced behavioral feedback loop that's going to benefit you over the very long term.
Right. And it works in the context of a diversified all-weather portfolio. I can tell you that my stress level from managing an all-weather style portfolio is very low because I've always got something that can thrive in whatever kind of market environment that we're going into. And just having a plan and a set of rules for rotating out of stuff that's not working and rotating into stuff that is working in a slow, methodical, responsible manner It just suits my needs, fits my personality. And I was just really, I don't know if thrilled is the right word, but very, very satisfied that I stopped talking at financial advisors, started listening to them, and realized that there is this reoccurring theme over and over. And, maybe the education, I need to apply it to myself. Maybe they really are just looking for an all-weather solution, and that's just an ideal alternative investment to them. We're going to find out.
And this, but few points of clarification. Your fund's not called All Weather, and this isn't related to like Bridgewater All Weather or something. It's just a phrase, right?
It is a phrase. I'm a big fan of Bridgewater. I like what they do. I see a lot of similarities and parallels. We can't do everything that Bridgewater does inside of a mutual fund, but if you look under the hood at what managed futures strategies do, and you marry that to long only global equities, and you plot it through time, it looks eerily similar to what you see from these really high profile hedge funds that are using what are purported to be much more complicated strategies. So I feel like they are benefiting from some of the same phenomenon.
Although I would argue which is getting a little off topic here, but like Bridgewater and those risk parity strategies are going to have trouble moving forward because of the bond issue that we've talked about.
Yeah, there's a big difference between risk parity and all weather. Risk parity, in my opinion, is anything but all weather. It's kind of just one season, and that is, it depends. There are some good risk parity products out there that are using commodities in different ways, but kind of the plain vanilla risk parity approach is not all seasons. It's kind of just one season.
Which season?
The good season, strong equity markets,
right, summer, and then there's a huge thunderstorm and you're caught out in the rain, right? Because like Bridgewater's has done pretty poorly in 2020 here, as far as I know. But we'll cover that later. So, and then talk to me for a second. Inside of this, there's all sorts of things, right? You could be long palladium, you could be short cotton, you could be doing all these different markets, right?
Yeah, so just like the SG Trend Index, which is focused on the biggest trend following firms out there, what we do is apply an old school, medium term, globally diversified trend following approach to metals and grains and softs and bonds and currencies and whatnot, just looking for wherever the macro themes are going, wherever the opportunity is going, and staying away from stuff that's not working. So it's the same stuff people have been doing for 40, 50 years now. And
I like that better. Like you're saying, it makes... Right. I feel like the old way was, hey, you're going to get exposure to all these asset classes. You're going to get to be long, short grains, long, short energies, but it is confusing. Like, how can I be long and short all those different things at all these different times? Whereas here, you're kind of just saying, hey, it's going to capture these different environments. It doesn't care what the unemployment picture is. It doesn't care if there's a global trade war, right? Ultimately, whatever's going to happen is reflected in price. And it's going to capture the trends in those prices.
Yeah, and I think there are structural risk premia to underwriting the risk associated with those trends. And I think
which
that's
we've
why...
talked briefly about before. Can you briefly touch on what you believe that is? Basically the commercials needing a hedge?
Yeah, so I think trend followers provide liquidity to a very large, deep-pocketed group of participants in the markets. And take risk that the other group doesn't want to take, and in return collect a sustainable risk premium. And only trend followers are the ones willing to do that.
So it's Southwest Airlines wanting to sell oil or buy oil futures in case it goes up and their gas prices get more expensive, and you're willing to sell that to them.
That's one example. It can be very complicated. There's producers, there's consumers, there's pension funds, central banks, there's trends in currencies and metals. There's spread traders, three-way spreads. There's all kinds of stuff going on. The bottom line is that the reason these trends persist when academically people feel like they shouldn't is because it's a marketplace. The futures markets are a marketplace where you get to transact. And if you provide valuable liquidity to a deep-pocketed person that's not profit-seeking in the futures markets, you should be able to collect a risk premium over the long term. And I think that's exactly what's happening in the trend-following world. I wish more people understood it, but they don't. But that's not the point of this presentation. It's to show that managed futures has been around for 40 years. Combining managed futures with stocks creates this thing that I characterize as all weather. And I think that that is pretty much what people are describing, or at least the results of it, when they're describing what they think is an ideal alternative investment.
And so what would you say to, right, like if I just look at this managed futures column, 15, 16, 17, 18, and this kind of ties back to what you're saying, like no way a client would have held through all 4 of those years, right, where the best annual return was 2%. And you had a down 6, a down 8. So that's the issue, right? And a lot of people wrote a lot of ink on trend following's dead. There's too much money in it. The central banks are interfering too much. So none of these trends can get rolling because the world's banks will come in. I asked, I don't know if I asked a question there, but what are your thoughts on I'm understanding your point of like, yes, a client couldn't go through those 4 years without ditching that, even though it's very helpful. So that's why you need to blend it. But
let's go back a slide.
Yeah.
How many people chose blue? Nobody chose blue.
Right.
Everyone chooses orange for a reason, and it's because of what you pointed out. Orange is benefiting from the non-correlation and the diversification between blue and red. Blue on a standalone basis, nobody chooses it on a standalone basis. So if you allow them to evaluate it on a standalone basis, you're going to have an uphill battle.
Right. But I guess my question is if maybe there's a purple out there and it'd be better if we could just put purple in, right? That's a little bit better in blue, perform better in those 4 years. But it seems like that's back to the ineffective slider and that you just kind of go in this weird circular motion of, all right, I'm putting something in that looks better in that period. No guarantee it's going to look better in the future periods.
Yeah, I think that's fair. I don't think that, I think that if just making managed futures slightly better was the solution, then we would have seen adoption and people being happy with managed futures. We don't see that. When I present something like this to people, they very quickly point out that no, I would not be happy with these results, but I would be very happy with these results. And then when I reveal to them that these results include those results, they're very, very surprised. So no, I don't think the incremental improvement in managed futures is addressing what the real issue is for advisors.
And I think to me, it comes back to, yeah, you can try and improve that diversifier bucket, but then you kind of get so far off course from what the purpose of it is, you might take away some of its diversifying abilities, right?
Right.
So a lot of these big trend followers, to fix that underperformance, they added more long bias, they added more equities. So they became more of a non-diversifier. So if you were just sticking with that as the diversifier, you actually became less diversified. And it seems your model's more of like, hey, I'm just doing this classic. You're kind of trying to capture the beta of trend following, if you will.
Yeah, I think it's a fair characterization. It's the beta without the fees. You know, obviously we're not charging 2 and 20 because we're not in the hedge fund world. And, you know, we benefit from some capital efficiencies too. You know, these are just indexes and we're blending them together 50-50. In the real world, if you're actually doing all this under one umbrella, there's a lot of capital efficiencies where you can use the same pool of capital. So you can run a full managed futures program and then just use the cash that you have to invest in global equities.
Yeah, and I think that's a good point. Let's make clear that this isn't your actual returns. This is just proof of concept.
Exactly.
And then let's move forward and talk about your.
Jeff, I have a side story that just goes right into what you guys have been talking about.
Okay,
Back in
Tom,
the day, I had, of course, managed futures. We traded commodity options and we traded currencies, actual FX, and we traded various mutual fund timing stuff. So I had equities and futures and currencies all blended together. I went out in the last year at Trendstat and did something like 150 appointments to institutions, primarily fund of funds and family offices that already had huge amounts of equity exposure. That would be column A. Of course, I had a lot of futures exposure, kind of column C. I went through and took their actual public track records that I could find and blended in what I called market math, which was our fund that did all this alternative investment stuff. And I showed them that blending in a very small portion of that fund would always improve their return to risk ratios, improve their returns, reduce their risk. It was cost effective. It was easy to buy it, and et cetera. I got $0 out of 150 appointments and promptly retired. And happy to see that Eric is doing what he's doing. And that's why I got involved in it as the chairman, because it just makes so much sense to me. It's kind of what I was trying to get to, but Eric has worked tirelessly to get to where he is, and I'm a big fan.
Awesome. Thanks, Tom. I lost my train of thought a little bit there, but Eric, you were going to go into what's 2020 looked like.
2020. Yeah. So, so we're a new company, Standpoint. We formed the company in 2019 and then went live at the beginning of 2020. And I had no idea that we were headed into, I don't even know how to characterize this market environment. So, but you all know what happened. But I think managed futures paired up with equities, kind of that all-weather approach, has handled itself very well. In some ways, 2020 has been a blessing because we were able to demonstrate, why you would want such an all-weather approach. If you didn't want to have to deal with a 33% decline in the stock market, followed by the fastest decline, followed by the fastest rebound ever, and then the massive volatility we've had in energy markets and bonds and whatnot. So, yeah, I would say that this is a good year to showcase the benefit of having an all-weather program as it pertains to what advisors tell me they're looking for in an alternative investment, and to compare and contrast that to existing alternatives, many of which that were on that ineffective list have done it again. They lost money during the COVID sell-off and have yet to recover. You might be thinking, how much longer can these actually be asset classes? I don't know, but they continue to do the same thing that advisors do not want. And I think that an all-weather approach like this, and we're not the only firm doing stuff like this, continues to be pretty much very, very close to exactly what they say they want. So we'll find out if we're right.
Yeah. Talk through a second of, you had gold up on I can't remember what it was, impractical column. But a trend following approach could capture gold. It can capture an inflationary environment, right? It's not mandated to do so, but there's no reason it shouldn't capture that. So you can kind of have your cake and eat it too with gold.
Oh, that's a good question. Gold as a standalone investment has been incredibly effective since the year 2000. Probably the best diversifier out there. Really high returns, great diversification quality. In the decades prior to that, it was not very effective at all. It was basically a license to lose money. So the question becomes, well, why don't you just apply a trend following approach to gold? I'm never a fan of trend following on a single asset class without some caveats, because any asset class can whipsaw you, 3, 4, 5, 6 times in a row. So I prefer to just have gold be a meaningful portion of our globally diversified, futures program, and just let the trends and the macro themes take us to where we need to be. That being said, gold has proven itself historically to be a great hedge. I just like managed futures better. I think it's got more capacity, more scale, and it's just incredibly diversified. 75 different markets around the globe from 5 different sectors. So no, I wouldn't recommend trend following on gold as a portion of what you do. Absolutely, as a individual alternative, I wouldn't be a fan.
I think we did a blog post, or I tweeted it out, I can't remember, but we had silver on a simplistic trend model. Silver had lost 19 trades in a row, I think, going back a dozen years or more. And then this year caught the huge move up in silver as gold had come so far and silver went to catch up. So it's also about tons of small losses in order to get that one outlier move.
Right. And remember what we're trying to do here. We're trying to solve more problems than we create for advisors. And that means delivering stability, durability, resilience, and 19 losing trades in a row is not the way to do that. Even if it's the right thing to do mathematically for the long term, advisors need to survive the short term. They need to make clients happy, but basically they need the overlap between what clients want and what clients need. You got to find that safe zone. It's got to be something that works long term. has a realistic expectation for returns and volatility and whatnot, but it's also got to be acceptable to investors. That's just real life, and that's what we're about.
I'm reminded of, this goes around on Twitter every now and then. There's a picture of like a nice manicured landscape corner, like on a campus or something. And it says design, and then there's the footpath of all the students who cut the corner, and that's the user experience. So
Right.
User experience is important. Question here from someone on here. So he's private investor discovered. Do you have a little nickname? BLNDX, Blendex? What do you call it internally? The mutual fund.
Yeah, I call it Blendex, but that's
Blendex.
the ticker symbol.
Let's do it. So he discovered Blendex after listening to several podcasts. Good work. And one thing you wondered, do you consider the 50-50 split, is that mathematically optimal, or is that kind of the user experience, if that's the most understandable thing to advisors?
Yeah. So the beautiful thing about this is this opportunity that fell into my lap. Remember the story? I was talking with advisors. I started listening. What they were describing, I thought was eerily similar to what I built for myself and my partners. You know, what I felt was the optimal portfolio. So it was so similar to what I feel like they're describing to me that I said, well, I'm just going to launch the optimal portfolio. So yeah, so now it's not 50-50 notional, it's 50-50 in terms of risk contribution. So, and that's a different topic, but yes, what we're running is the Sharpe ratio optimal portfolio. It's the Sortino ratio optimal portfolio. And it's not exactly 50-50. Sometimes it's, 49-51. Sometimes they trade places and it oscillates. Obviously it depends upon market conditions, but 50-50 is right in the middle. So that's what you essentially want to rebalance to over time.
So it's risk balance based off drawdowns or volatility, or a combo, or what?
Yeah, it's variance. They're both contributing. Skew adjusted variance, which is going to be similar to drawdown. So, but basically what it boils down to is it's a full futures program. It's our full futures program, and then we just buy the ETFs and add them into it. It's not truly 50-50, and then only half your money goes into a futures program and then half into the ETFs. So if you do it how I just described, a full futures program at our target risk, and then we just use the cash to buy those ETFs, you end up with equal risk contribution if you buy them in the right amounts.
So it's, in that standpoint, in my brain, it's more like 100-100 instead of a 50-50.
No, I think it's more like 150.
Okay.
That's the way I look at it. Yeah. You couldn't do 100-100. You need, that would be too hot for the regulators. So, but it's not optimal either.
Got it. And the optimality, is that a word? Optimality?
We'll make it a word.
The optimality depends on the time frame too, right? So like if you're in 08, you'd go 90-10 managed futures. If you're, after looking at it just the past 4 years, you might go 80-20 the other way.
Well, so the nice thing about this approach is, and I've looked at hundreds, maybe thousands of different variants of ways you could do stuff like this. I've never seen anything as stable through changing market conditions and rolling 5-year return windows as this combination of just global equities and plain vanilla managed futures without the fees. So now, even with 2008, I think the maximum tilt was something like 70-30.
Got it. Sorry, I just had to yell. My kids just came home from school and are yelling and screaming. The last thing I wanted to ask of just the two things. One, is there an ideal environment for this? Is the more crazy things are, the better for this, or it doesn't matter? Like it should be, it's kind of the concept of all weather.
I struggled with that question a little bit when I first started getting it a year and a half ago. What's the ideal environment? Until I realized that, well, by doing this, you've essentially stripped away most of the cyclical aspects of investing. Global managed futures is very, very different from long only global stocks. The cycles are different. The cyclicality is just, the amplitudes are so different that to a large degree, they offset one another. So I could just, cherry pick certain decades out of the historical, if you were using a simulation or a back test, and they look remarkably similar period over period over period. So what that means is I don't think there is particularly a good time or a bad time, because the cyclicality is to a large degree inoculated in this portfolio. So, and that's what you would expect in something that was designed to be as stable as possible through time.
Yeah, and you can kind of see that in the orange column there. There's not, right, like, hey, it works really good except for that 1 year in 2006 where it was down, 5 times what you would expect.
When I present this to people, oftentimes they say, all right, well, split it up into decades, because they say, well, stocks had a lost decade here, but they thrived there. Managed futures was great here, but it sucked here, so on and so forth. And then they're surprised to see that all weather, basically this decade, had the same risk adjusted statistics as the second decade. Everything else flip flopped from good to bad or bad to good. Yeah. But this all weather approach did what you want, which is to stay reasonably stable through time. And I can't guarantee you that's how it'll always be in the future, but that data, all that historical data, it's powerful and meaningful to me.
Right. That's, in theory, you could have a decade where it's bad, but that's hard for me to envision, right? Of how could you have a meaningful equity downturn without trend following returns? I'm sure we could think up some unique ways that could happen, but it seems it would be hard for that to happen.
Yeah, I think it's possible. I think what's more possible, though, is equities and bonds struggling at the same time.
Yeah, which nobody's seen in years and years. All right, and then last piece, which tie it back to the beginning, we're talking about, what do you do with that bond allocation? So it seems the implied thing is this would make a lot of sense to replace that bond allocation with, or not the whole thing, but pieces of. How do you view how much to allocate to this, and what it should replace, if anything?
Well, I caution people against, getting rid of bonds and then adding this in, and expecting it to behave like bonds. Nominal bonds are going to thrive if we get more deflation. An all-weather portfolio made up of managed futures and stocks might not thrive at the same time. Yeah. So the power of this is that the diversification benefit that this brings to the portfolio, historically speaking, and the historical returns means that if you had to get rid of bonds, but you needed to maintain your returns and your volatility and your diversification historically, this would have done a really good job historically, but in a different way. In fact, it would have done a better job by my calculations, more tax efficient, higher risk adjusted returns, but it did it in a different way. This is not only uncorrelated with stocks, it's also uncorrelated with bonds. So that's an opportunity. It's also a risk in the sense that I don't want anyone to think I'm telling them, hey, swap the bonds for this and you'll be fine. This is different from bonds. I think it's an ingredient that's accretive to your overall portfolio, but you shouldn't expect it to move and behave just like bonds going forward. So that would be a mistake.
I'm full of those. So last bit, let's open it up to anyone else have any questions out there. You can unmute and ask live or chat them in.
Jeff, I was just going to say what you just talked about with bear markets and equities. My experience for trading commodities and futures for about 40 years now, when stocks get into a really plummeting emotional sell-off, every study I've ever done has shown that stocks move faster down than they tend to move up. So the emotion gets really high. It starts spilling over sometimes into futures, and other studies that I've done always show that trend following futures traders tend to have a better result or more potential for having a positive year when you have movement. If there's no movement, it's really hard to see how you can do anything other than get whipsawed all the time in futures. So having the kind of the catalyst of tremendous bear market down 50, 60, 70, 80% on stocks kind of provides a little bit of ignition over on the other side sometimes. And it makes a lot of sense to me. That's the way I would run my assets. Been doing that for years.
Love it. I think we're all fans of that approach. And then I'll leave you, Eric, with your thoughts on kind of the market moving forward, what we're going to see. And you can say, what I think you'll say is the models don't care, but in terms of election volatility and if we have a contested election out until the inauguration and all that jazz that's in the headlines. Do you account for that in your models? Do you care?
It's more the same, just there's more leverage in the system this time around. So our job is to be prepared and to always be as prepared as we can be, and then to, in a disciplined manner, take action when warranted. So, and that's exactly what we're going to do for the next 20 or 30 years. Election, it doesn't matter to us. In fact, I think.
But sorry, real quick, being prepared doesn't mean you're sitting there in front of the computer watching the Bloomberg headlines and clicking buttons. Being prepared means you've already developed the model that's going to risk very little. And if it catches an outlier, it's going to make many times that amount.
Yeah, thanks for pointing that out. It doesn't mean sitting here and day trading. We have a plan, a strategic plan, and then the tactical rules to execute it. Everyone's agreed to it. Everyone knows what it is. We have our risk controls in place, and we stick to the script and maintain discipline in a slow, methodical manner. And that's what we're going to do. And elections come and go, missile strikes come and go, tsunamis. This isn't the first crazy election. It won't be the last one we have. So you got to invest through them. Everyone else has to invest through them. We're going to do the same.
That would be my thing to add to the I keep forgetting what it's called. The not ineffective column, the impractical. What was it called?
Mm-hmm. Impractical.
The impractical column, because there's no narrative there. When it's a systematic model, you can't, right? These investors want like, well, the election, no, we didn't see that coming and we were loaded up on the wrong side of the trade. Right? Like we bought Sears, we bought all these other hedge funds have these narratives that they can put with their losing trades. Whereas managed futures, if it's losing, it's just because there wasn't directional volatility. There wasn't an expansion of the ranges. We came into the move short bonds. We came into the move long stocks. Like the narrative is rather boring in order to stick with that stuff.
Yeah. And narratives for a systematic managed futures manager are tough. They're always in demand, but they're hard to come up with.
Yeah. Well,
which is why it's even more important to not be any more cyclical than you need to be. That's why I like the all-weather approach, because it gets rid of, by mixing those two asset classes together, I feel like you get rid of 80% of the problems, but you keep 80% of the benefits. So, and one of the problems you get rid of is the need to come up with constant narratives to defend volatility, because you're not creating a lot of volatility for people.
Yeah, I love it. And then I sort of don't trust your all-weather theory because you live in Phoenix, right? If you lived in Chicago, we have all the weather. We have sunny, hot. We've got fall right now where it's rainy and gross. Then it's going to be -30 here in a little bit. So,
well,
I'm wear that someday.
I'm from southeastern Kansas, which I think is the only place in America that's windier than where you live, and we got all the weather there too. So I'm enjoying the sunshine in Phoenix, Arizona. Although I've been here 20 years now, I'm starting to wimp out. Like the summers are finally starting to get to me. But it was a nice run for a while, getting away from that Midwest weather.
Yeah, just move here for one winter, and you'll be good for another 20 years there. Any other questions out there before we wrap up? Going once, going twice. All right. So
that either means I did a great job or a terrible one if there's no questions. So we'll find out.
I think it's the former. I can't remember the order. Great. Well, thanks so much. We'll email everyone a recording of this plus the link to the other podcast we did with Eric. So thanks everyone for attending.